Hi, everyone. Welcome to our Financial Inclusion Week presentation, Why Don't the Poor Buy Insurance? My name is Shariel, and I lead impact measurement at Gojo & Company, where I run our financial diary projects in Cambodia and Sri Lanka. I'm joined today by my colleagues Rajalakshmi Kamath and Catherine Wanjala. Rajalakshmi, could you introduce yourself?
My name is Rajalakshmi, and I'm a faculty member here at the Indian Institute of Management, Bangalore. And I was in charge of the Ramnagaram Financial Diaries, about which I will speak about, which were held in 2007, 2009. Thank you.
Hi, everyone. My name is Catherine Wanjala. I'm a research consultant in Kenya. I had a privilege of working with the Kenya Financial Diaries in 2012, 2013. Dealing with and I deal mostly with financial projects. Thank you.
So today we'll be discussing what we know about how poor people manage risk from the perspective of our 3 financial diaries projects in Kenya, India, and Sri Lanka. We'll answer questions like, why is insurance, which is so intuitive for wealthy people, so unpopular among the poor? How do the poor actually manage risk? And what can financial service providers learn from this for product design? And for insurance providers, what could help to make insurance more successful for low-income people? Now, we'll introduce the financial diary projects we worked on, starting with Ramanagaram.
So ours was a financial diaries project held among 90 women, and the women were keeping the diaries themselves. The citation is given where the details of the diaries are given, and these were kept for a period of 11 months. The major finding of the Ramnagaram Financial Diaries project was the minutiae of loan repayments mattered far more than the big impact stories of impact assessment.
Next, the Kenya Diaries.
The Kenya Financial Diaries focused on 300 households, both in urban and peri-urban areas. And we did bi-weekly diary visits for each of those households, where we recorded the cash flows, and we also recorded the major events, the going-ons, and also we did some writes up on journals. And most of these things that we discovered, what we learned was through those bi-weekly visits that we did. And we introduced some modules that like risk modules that we would interview main respondents within the households. Thank you.
The Sri Lanka Diaries are the newest project among the 3. We started in November 2021. We have 95 participants in 9 areas in Sri Lanka. And like in Ramanagaram, we do self-recording in notebooks with the diarists. The notebooks are then photographed by enumerators once a week. The main story of the Sri Lanka Financial Diaries is the financial and economic crisis that took place in Sri Lanka in 2022, which we see reflected in the lives and transactions of our participants. So the theme of this presentation came out of a visit to our diarists in Sri Lanka, where we noticed that out of the 20 or so diarists we were interviewing, a surprisingly large number, around 14, had been affected by recent crises which had put a strain on their finances or resulted in loss of income. These crises ranged from death of a main income earner to sickness of a family member to a landslide causing the collapse of the family's house. And all of this was against the backdrop of the economic crisis of 2022. So our first reaction as researchers was to wonder why none of these diarists had any insurance. When we asked them, people just reacted with sort of disbelief. Why would I want insurance? I don't trust insurance. When we look at the data across our financial diaries projects, we see that in general, although crises of one sort or another are common, insurance is not. Now, the question about this is why? Why is insurance unpopular? When we put ourselves in the shoes of people who have small and unstable incomes, we see that insurance actually just doesn't make sense as a way to allocate your money. So many things could potentially happen that would result in loss of income or significant disruption to your way of life. Natural disasters like flooding, sickness or accidents, death, car trouble, crop failure, and more. However, you don't know if these might happen or when they might happen. So to insure yourself against these risks, you would have to pay for multiple specific insurance schemes for an unspecified length of time. This is in addition to paying for all the things that you definitely need today, such as food, clothes, your children's education, utility bills, and rent. Rather than allocating any money that you have left over after these things to guard against highly specific uncertainties that might or might not happen, it makes much more sense to allocate your money to things that will generate a relatively sure return, such as jewelry or chickens. The other thing that we often see happen is that everybody knows someone who has bad experiences with insurance. Either they got sick and they tried to claim their insurance and they discovered it wasn't applicable, or they got sick and they tried to claim their insurance and the money just never arrived. They never heard from the provider. So many people have trust issues with insurance on top of everything else. So if low-income people don't have insurance, how do they actually manage risk? We'd like to share some stories now from our financial diary project, starting with Kenya.
What we learned from our diaries project is that there are so many ways that people would deal with the risks and events that happen in their lives. And what stood out were gifts and loans from friends and family, because resources received is one of the major ways that people were earning income. So these are the same ways that they use to cope with the risk that they faced in life. However, some of these help was not timely. There are occasions where we noticed our respondents struggling. For example, one of our respondents had a sick wife and needed money for treatment, around 70,000 shillings that they would use for treatment. And they tried to raise that money from friends and family. For the first attempt, they managed to raise around 30,000 shillings, which was not enough. And unfortunately, the wife died. Again, they went back to their friends and family for help to be able to cover the funeral expenses. This time round, they raised around 90,000 shillings, which was even more than what they needed for the treatment of, his wife. If that money had come in earlier when they needed money for treatment, then the wife will still be alive right now. But these timings, when you need this money, it's not guaranteed that your friends or your family will be able to raise that much at that particular moment. So it turns out that even for those who have insurance, the few that had insurance products, we realized that they were not aware of it because it was bundled up with other things. For example, we have respondents who had life insurance bundled up with farm products because they were paying for the farm products bit by bit as a form of loan. So when they're doing the loan repayments, they were also they did not know that the insurance product is bundled up with that loan. One of the beneficiaries of the insurance life insurance products received the money when already the funeral had already happened. So when the money came in, they had already looked for other ways to solve or to raise money for the funeral. So when they received the 24,000 that the insurance was paying, they put that money into something totally different that was not meant for at that time, which means that if this insurance product had been there, if they had known about it, then it would have helped them during the funeral and to deal with the funeral expense. But due to that I don't want to call it miscommunication, but because of lack of that information at that time, they had to seek other ways to deal with the problem. And as you can see, the money that they received, 15,000 went to buying a cow, and around 2,800 bought maize, which they used as food stuff in the house. And 6,000 shillings was divided among her daughters, who are the ones that were paying for the 1 acre farm. So in this case, the insurance did not do what it was supposed to do, and it is supposed to help them cope with the event that actually the product is meant for. Thank you.
In the Sri Lankan context, the first full year of the diaries coincided with a monumental economic crisis in Sri Lanka, the main features of which were rampant inflation and food and fuel shortages. By June 2022, the National Consumer Price Index was 40% higher than it had been in January, and we saw diarists losing work due to the rising costs of materials and fuel. Among our diary sample, we saw spending on food rise in proportion to incomes until food expenses accounted for 70% of income in July 2022 and stayed at that level for the rest of the year. In these extremely difficult circumstances, we started a monthly survey asking diarists how they were coping with the crisis. One of the questions was about whether diarists sourced funds from outside their household in the past 2 weeks. In July, around 1/3 of diarists said that they had turned to external sources of funds to pay for food and medicine. And to corroborate what Kate says in the Kenyan context, most of them sourced funds from friends and family. One additional source that doesn't appear in the Kenyan diaries is gold loans. Jewelry is a very common form of savings in Sri Lanka, and many families pawn their jewelry at this time to buy food. So, putting together our observations across our diaries projects, we came up with this matrix which ranks risk management strategies from least to most popular and first to last resort. So, if you have an emergency, in general, the first resource that you turn to is usually cash at home or in your mobile money wallet. If that's not enough, then you might start to ask your family for gifts and remittances. If that's still not enough, you might then sell some liquid assets such as chickens. Or if that's still not enough, then you might start to turn to methods that would take you a little bit more time to negotiate, such as loans from friends and family and employers, or asking your savings group, your Raska, if you can get your money early. And as an absolute last resort, you might sell some cows or pigs, which are typically more illiquid assets that people hope to sell for the right price at the right time. Now, going below the line, typically we see that cash in the bank is less popular among diarists. But if you do have cash in the bank, usually that's one of the first things that you might turn to when you have an emergency. Insurance is also not popular, but if you do have it and it is applicable, then it's probably one of your first resorts in an emergency. MFI and bank loans, at least in Kenya and Sri Lanka, are probably one of the least popular strategies for dealing with risk. And the reason for this is because it takes a while to apply for an MFI and bank loan. It takes a while for you to receive your cash, and that's not very useful in an emergency when you typically need to receive cash urgently. Also, when you're facing potential income disruptions or loss of income for the foreseeable future, the last thing you want to do is take an MFI or bank loan that you will have to repay in future. This is all in general, but each of these items moves around the matrix depending on country to country. For example, jewelry is not popular everywhere, but in India, in Ramanagaram, it might be most families' first resort in the case of an emergency. Now, I'd like to hand over to Rajalakshmi to share a bit of the Ramanagaram context, which is a bit different.
The Ramanagaram context is probably an exception where risk mitigation strategies were concerned. Pretty much like Sri Lanka, Ramanagaram also had a crisis, but a more local and an endemic crisis of the silk sector. The only difference was there was a proliferation of microfinance institutes already in that place and ever expanding. And as a result of which borrowers used the MFIs as a risk mitigation strategy, meant that they were constantly caught up in making repayments. And these repayments, pretty much like in the Sri Lanka case, also came at the cost of food. So the only lesson that we kind of learned was that if the borrowers are using MFI loans as a cash management strategy, then it needs to be, the repayments need to be tailored to their household cash flows.
Great. So now, what are the implications of all of these observations for product development? In truth, a lot of these risk management strategies that we've covered are in themselves risky. you could have a fight with your family and friends. Your chickens or your cows and pigs might not be ready to sell. We believe that formal financial services could have a role to play here in offering less risky risk management strategies to people, options that will be available regardless of the weather or people's relationships with their family or neighbors or the health of their livestock. So from a product development perspective, what makes the existing risk management strategies that people have attractive? In the Kenya Diaries, they have a phrase that I really like: money should be working. And what this says is that sources of money should be able to serve many different purposes at once. What we see in the risk management strategies that we reviewed is that many of these strategies are extremely flexible and extremely fungible. You can use these sources of money for many different things, and there's a variety of liquidities to meet a variety of needs. The other thing that we see about these strategies is that they give people a high degree of control, and that they tap into people's sense of trust. People are able to trust their friends, their families, and their neighbors, and that gives them a greater sense of control over their emergency resources. So this prompts us to ask questions like, how might we enable people to do more of what they're already doing? Some of the most useful products out there are ones that fit with how people already manage their money, not ones that try to convince people into a different paradigm of thinking about their money. For example, people already reach out to their networks to ask for money in times of need. Messaging services like WhatsApp and Facebook Messenger enable people to reach more people. How might we de-risk some of these strategies for people? This could include, for example, bringing services closer to people or into the community to increase a sense of transparency and trustworthiness. How might we provide people with a greater degree of control? I think it's really important to note here that financial products don't have to be, and perhaps shouldn't be, specifically designed to help people with emergencies, as long as people have a high degree of control over them and the proceeds can be used flexibly. Many products that are not specifically designed to help poor people manage risk can and will be used for this purpose. So with this in mind, rather than recommending specific products that we believe are useful for low-income people to manage risk, we'd like to introduce 3 features that we believe useful products need to have. The first feature is timing. The timing of inflows from any loan, insurance, or savings product needs to match the expense that a client would like to make. This means that in order to be useful, inflows need to be dispersed quickly and flexibly. This graph shows a scenario where someone has to make a large emergency payment. If they didn't have a corresponding inflow, the result would be a very large hole in their resources, which they would then need to earn back over the next few periods. However, if they have a corresponding inflow at the same time that they need to pay for this emergency, it offsets their outflow out of their own pocket and makes the impact to their resources smaller. Having this inflow at the right time essentially moves some of the large payment that they had to make in December forward in time, enabling them to pay, if we imagine it's a loan, enabling them to pay a portion of the original inflow in installments over time. Now, imagine a scenario where the person had to make this large emergency expense, but didn't know if the funds that they needed were going to come in or not, or if they would come in at the right time. In this case, as Kate mentioned in her story just now, this person might not spend as much on the emergency expense as they ought to. If it's, for example, a medical expense, they might not spend as much on treatment as they need to, and the result could be disastrous for their family. The next feature that we want to highlight is convenience or proximity. And one example of this is daily deposit collector schemes in countries like Bangladesh or elsewhere. where a deposit collector comes around to people's workplaces or houses to collect whatever people want to save that day. These schemes are extremely popular where they're available, and we find that convenience helps people to prioritize doing things that they know that they should and that they want to, when there are many other things competing for their attention. We also find that people are usually willing to trade off affordability for convenience. They're willing to pay a little bit more or receive a little bit less interest on their savings in order to receive a very convenient service. One example of a very convenient product that we tried introducing in the Sri Lanka diaries was savings tills. We offered diarists the option of a clay till and a wooden till, and diarists could choose to receive as many as they wanted of each. Initially, when we offered the tills, we were unsure about whether people would have enough to save in the difficult economic climate. But now, 9 months after offering the tills to diarists, looking at the data and speaking to diarists, we've learned that the tills have been even more useful to diarists than we originally expected. What we've seen is that the number from the diaries data is that the number of savings deposits increased several times dramatically after introducing the tills. And when we visited in July 2023, 9 months on, we found that almost everybody was still using the tills even more actively than we had realized, because some people were saving and using money from their tills, but not recording it in their diaries. For example, some people used their tills to build up lump sums to pay for shop rent or to invest in new business ideas, while others saved whatever loose change they had every day and used it to buy groceries on days when they couldn't get any work. Rather than saying that they didn't have enough to save because of the economic crisis, we found that diarists actually saw the tills as an essential way to smooth their cash flows and manage their money in a time of great uncertainty and instability in both their income and expenses. A type of cash flow smoothing and management that was only possible because these tills were sitting right on their mantelpieces at home. The third feature that we'd like to recommend.
The third feature is about community. We are here talking about people very, very vulnerable without any safety nets, and one cannot deracinate the meaning of community for such borrowers. What has been happening recently is that the community is merely being used as a tool or a font. Groups are being designed just for the purposes of giving individual loans. There's a lot of hand-holding that needs to be done the way it was done in the erstwhile days of the SHG bank linkage movement. But even if that is not done, I think if private financiers can think of getting employees from communities where the community is well known, that would be at least one step forward.
Having people who are well known to their communities working for financial institutions means that clients are much more likely to turn to those people in times of need. And those people are also more able to listen to and advocate for clients when they need flexibility in difficult times. So going back to our original theme about insurance, if you are an insurance provider, or if you're thinking of providing insurance products to low-income people, what could help make insurance more successful? In business, there's a common concept called the iron triangle, which sort of summarizes the qualities that people would like to see in a useful product or service: cost, scope, and schedule or speed. In the case of insurance, cost is about affordability of insurance for low-income clients. Scope is about the usefulness of insurance coverage. Does it apply to the things that people to the risks that people value? Speed is about the speed of responding to claims, disbursing insurance funds, essentially clients' ability to trust that insurance money will arrive when they need it. At the moment, when we talk to diarists, we find that many insurance schemes are failing low-income clients on all three aspects. So how can we improve on these? We have a few ideas. In Kenya, there is an example of several companies, KCB Bank and Dove Nest Insurance Company, insuring groups rather than individuals. This helps to reduce their cost of outreach and also reduce the premium price for group members. In terms of scope and coverage, what we think is important here is for companies to do research on the types of insurance that low-income people value. What types of risks are really important to low-income people, and what do they really need insurance for? It's also important here for companies to be able to communicate the benefits of insurance to people in ways that they can relate to. Finally, on speed and schedule, in addition to making sure that insurance payments can be disbursed quickly when people need them, it's also important to take into account the instability of incomes for poor people. Insurance payments are much more sustainable if they can be flexible for low-income people so that they can pay them at times that are convenient to them. So these are just a few ideas today about how financial products could be better designed to help low-income people manage risk. Thank you very much for listening. Please put any comments or questions in the comments box. We look forward to reading them. Thanks very much. Bye.